Imagine for a moment that you have, I don't know, $1 billion.
It's a nice thought.
A very nice thought, right. But now you have a genuine problem. Where do you actually put it? I mean, you can't stuff $1 billion under a mattress.
No.
And you can't just leave it in a standard checking account because, well, if the bank goes under, you're out of luck. For the last, 80 years, there's been really only one answer to that question if you wanted absolute sleep-at-night safety.
You buy U.S. Treasuries. You buy the debt of the United States government.
Exactly. It is the risk-free asset. It's the bedrock of the entire global financial system. When the world gets scary, you buy treasuries. When a war starts, you buy treasuries. It is the baseline for everything.
Mm-hmm.
But today, we are looking at a stack of research articles, data sets, some pretty heavy charts that suggests this bedrock isn't just cracking, it might actually be crumbling.
Crumbling is a strong word, but the data is definitely pointing toward a structural shift. We are looking at what the sources are calling the Great Exodus.
The Great Exodus.
And I think the most important thing to say right up front is that this isn't some future prediction. It is happening right now.
And that is our mission for this deep dive. We need to unpack who is selling U.S. debt, why they are selling it, and that's the part that really surprised me. And ultimately, what this means for your money.
Yeah.
Because this isn't just high-level Wall Street noise. This isn't just lines on a Bloomberg terminal.
Not at all. This hits the mortgage rate on your house. It hits the price of your groceries. It affects the safety of that 401k you're relying on. We're talking about the plumbing of the global economy here.
And if the pipes burst,
everyone gets wet.
So let's start with the who. When I went through the data on global capital flows you shared, the sheer scale of the selling just jumped out at me. We aren't talking about a few hedge fund managers getting nervous.
No. We are talking about nation states. In just the last 18 months, foreign holdings of U.S. Treasuries dropped by over $300 billion.
$300 billion.
Now, in a multi-trillion-dollar market, you might think $300 billion is a rounding error. But you have to look at the trend line. It's a massive amount of liquidity leaving the market in a very short window.
It's like watching the tide go out, much faster than usual.
That's a good way to put it.
And the biggest seller is the one everyone always talks about, China. The data here it's pretty stark.
China is the headline, yes.
Ah.
If you go back to, say, 2013, China held over $1.3 trillion in U.S. Treasuries. They were essentially financing U.S. consumption. We bought their goods. They took that money and loaned it right back to us.
And today,
that number has fallen to barely $775 billion.
Wait. So they've dumped nearly half their position. That's a roughly 40% reduction. That feels huge.
It is huge. And it's a strategic unwind. You don't sell 40% of your primary reserve asset just to, rebalance a portfolio.
No.
That's a deliberate move to reduce exposure to the U.S. dollar. They are voting with their wallet, and the vote is exit.
But here's the thing that confused me at first. I expected China to be selling because of all the trade tensions. We know that narrative.
Mm-hmm.
But the data shows Japan is selling too. And they are our closest economic ally in Asia. Why would they be dumping treasuries?
That's a great catch, and it's a critically different motivation. Japan isn't selling out of spite or geopolitical maneuvering. They are selling out of economic necessity.
Necessity? How so?
They've been selling treasuries to defend their own currency, the yen. The yen has been weak, so they sell dollars to buy yen. But the net result for the U.S. is exactly the same.
Our biggest, most reliable buyers are leaving the auction house.
Exactly. It's like holding a party and your two best friends, the ones who always bring the tips and dip, decide not to show up.
Yeah. And then you have the third group mentioned in the research, the petrodollar nations. Saudi Arabia, the UAE. Can you just remind everyone how that cycle used to work? Because my understanding was that they sold oil, got dollars, and then essentially had to buy our debt.
All right, that was the petrodollar recycling system. It was the deal for 50 years.
A perfect circle.
A perfect circle that kept U.S. borrowing costs artificially low for decades. But that cycle is breaking. The source material highlights that these nations are now actively diversifying.
Diversifying into what?
They are taking their oil profits and buying gold, they're buying European bonds, and they're investing in infrastructure projects across Asia. They aren't automatically sending that capital back to Washington anymore.
So if I'm reading this right, the source is basically calling this a vote of no confidence.
Precisely. And this creates a very basic supply and demand problem. The U.S. government is issuing more debt than ever before to fund our deficits.
Right.
But at the exact moment we need more buyers, our biggest customers are walking away.
Which forces a hard choice. I mean, the government has bills to pay. If the foreigners won't buy the debt, who does?
There are only two options. Option A. The Federal Reserve prints money to buy the debt.
Which causes inflation. We saw that movie during COVID.
Correct. Or option B. Domestic investors, banks, pension funds, regular people like you have to buy it. But here's the catch.
What's the catch?
They aren't going to buy it at current rates if they think it's risky or if inflation is sticky. They're going to demand a higher return.
They demand higher yields.
Yeah.
Which increases the cost of borrowing for the government and, as we'll get to in a minute, for everyone else. It seems like a lose-lose scenario.
It is. It's a tightening noose.
Okay, I want to pivot to the why, because this is where the research gets really interesting. It argues that this exodus isn't just about economics, it's about trust.
Yes.
And specifically, something the source calls the weaponization of finance.
This is the critical piece of the puzzle. If you want to understand why China and Saudi Arabia are really selling, you have to look at 2022.
The invasion of Ukraine.
Right. Now, we have to set aside the politics of the war itself. The source is very clear on this. We aren't debating the morality of the invasion or the sanctions. We are strictly looking at the financial mechanics of the response. When Russia invaded, the U.S. and its European allies froze roughly $300 billion of Russian central bank reserves.
I remember that clearly. It was hailed as a massive blow to Putin's war chest. We turned off his money.
We did. But think about how that looked to the rest of the world. Most of that money was sitting in what was supposed to be risk-free accounts, treasuries, euros, sovereign debt. It was supposed to be untouchable.
So if you're a central banker in Beijing or Riyadh or New Delhi, you're watching this and thinking, what?
You're thinking, if the U.S. can freeze Russia's reserves overnight because of a geopolitical disagreement, they can freeze ours.
Wow. It turned the risk-free asset into an asset with massive political risk.
Exactly.
It's like finding out your bank manager can lock your account just because he doesn't like who you voted for.
That's a great way to put it. It was a wake-up call. The source puts you in the shoes of these non-aligned nations. Do you really want 60, 70, or 80% of your entire national wealth held in an asset that Washington can switch off like a light bulb?
The answer clearly is no. It's too much exposure. So they're looking for fire exits.
They are looking for assets that can't be sanctioned. And that is why the source spends so much time talking about gold.
I noticed that. Central bank gold purchases hit records in 2022 and 2023. I think the number was something like over 1,000 tons bought by central banks.
Gold is the oldest neutral asset in the world. It's nobody's liability. If you have physical gold sitting in your own vault in Shanghai, the U.S. Treasury can't freeze it. They can't switch it off.
It's a direct response to this weaponization.
It is. And we're seeing the BRICS nations, Brazil, Russia, India, China, South Africa, discussing payment systems that bypass the dollar entirely.
They are trying to build a parallel system.
They are. Now, let's be realistic. They know they can't leave the dollar building completely yet. The global economy is still $2 dependent. But they are making sure the doors are unlocked so they can leave if they have to. They are building the fire escape.
Which brings us to the mechanics of what the source calls the doom loop. I love a good, scary economic term, but we need to break this down simply so everyone gets it. How does this actually work?
It's the breakdown of that symbiosis we mentioned earlier. Historically, foreign nations needed dollars to trade. This created a constant demand for dollars, which kept the dollar strong.
And a strong dollar allowed the U.S. to borrow cheaply.
It was a beautiful cycle for America. We got cheap stuff. They held our debt.
But now we're putting it in reverse.
Right. When foreigners sell treasuries, they are effectively selling dollars to buy something else, like gold or their own currency. When you flood the market with dollars, what happens?
The value of the dollar goes down relative to other things.
Exactly. And a weaker dollar makes holding dollar assets less attractive.
Which leads to more selling.
Ah, I see it.
That is the feedback loop. The more they sell, the weaker the dollar gets. The weaker the dollar gets, the more they want to sell to avoid losses. The source drew a comparison here to the late 1970s. I wasn't investing then, but I know the headlines. Double-digit inflation, gas lines, a general sense that the economy was broken.
It was a crisis of confidence in the dollar. And it's important to remember how we fixed it. Do you remember the name Paul Volcker?
The Fed chair.
Yeah.
The guy who crushed inflation.
He did, but the way he did it was brutal. He raised interest rates to nearly 20% to break the inflation cycle and convince the world that the dollar was worth holding again.
20%.
He essentially said, if you hold dollars, we will pay you so much interest you can't refuse.
I can't even imagine that today. Mortgage rates at 22%. The economy would just stop.
And that is the problem. We can't do a Volcker today. In the 1970s, the U.S. debt to GDP ratio was roughly 30%. It was manageable. Today, we have $34 trillion in national debt. Our debt to GDP is roughly 120%.
So if we raise rates to 20%,
The interest payments alone would exceed the entire tax revenue of the United States. The government would default immediately. So the tool we used to save the dollar last time is basically broken. We are much more fragile now.
that is a sobering thought. But I want to bring this down to the ground level. We've talked about billions and trillions, but why should someone, driving to work right now care if China sells a bond? How does this actually reach into their wallet?
It comes down to the yield curve. We have to understand that the U.S. 10-year Treasury yield is the benchmark for almost every other loan in the economy. It's the gravity of the financial system.
Okay, so explain the mechanism. China sells a bond. What happens next?
When there is more selling than buying, the price of the bond drops. Basic supply and demand. But bonds are weird. When the price drops, the yield or the interest rate rises. It has to rise to attract new buyers.
Okay, so the Treasury yield goes up to, let's say, 5%.
And because the Treasury yield is the risk-free baseline, every other loan sits on top of it. If the government have to pay 5% to borrow, a bank isn't going to lend to you for a mortgage at 4%.
No way.
Mortgage rates go up to 7% or 8%. Corporate bond yields go up. Auto loans go up. The cost of capital for the entire economy gets more expensive.
So your monthly payment for a house or a car is directly linked to whether or not foreign central banks trust the U.S. dollar.
Directly linked. You are paying a premium because China is selling.
Wow.
And there's another layer to this. The source mentioned a specific stat about the national debt servicing costs that is just, well, it's mind-blowing.
I highlighted that too. Every 1% increase in interest rates adds roughly $350 billion to the U.S. government's annual interest payments.
$350 billion. For context, that is more than the budgets of the Department of Commerce, Education, and Homeland Security combined. Just gone. Vaporized to pay interest to bondholders.
And the source says we are now spending more on servicing our debt than we spend on national defense.
We are. And that creates a vicious cycle. If we have to spend all our money on interest, we have to borrow more money to pay for actual services, which creates more debt.
Which creates more interest. This is the debt spiral.
Exactly. And if foreign buyers don't return and yields climb to, say, 6% or 8%,
It would strangle the economy.
it would crush the housing market
Yeah.
because nobody can afford the monthly payments. It would likely cause a massive correction in the stock market because companies can't afford to borrow money to grow. It's a recession scenario, but one where the Fed can't easily cut rates to fix it.
Okay. I can feel the listener's blood pressure rising. I'm feeling it myself. Before we all go hide under the bed and buy canned beans, the source does offer a counterargument.
Yes,
It's not all doom and gloom, right? There is case for the dollar sticking around.
absolutely. And we have to be balanced here. The source calls this section refusing to panic. The argument is that reports of the dollar's death are exaggerated because of network effects.
The dollar is still the heavyweight champ.
It is. It accounts for about 58% of global reserves. It dominates trade. If you want to buy copper in Chile or wheat in global markets or oil almost anywhere, you usually need dollars.
Right.
The infrastructure for the dollar is unmatched. You can't replace that plumbing overnight.
It's like the QWERTY keyboard. Maybe it's not the best design anymore, but everyone is used to it. Every computer uses it, so it stays.
That's a really good analogy. And there's the flight to quality argument. When COVID hit, or when those regional banks failed in 2023, where did the global money go? Did it go to Bitcoin? Did it go to the Chinese yuan?
No, it flowed into U.S. treasuries.
Exactly. History shows that when people are truly scared, they still run to Uncle Sam. The dollar is the cleanest shirt in the dirty laundry basket.
The best house in a bad neighborhood.
The euro has problems, the yen has problems, the yuan is controlled. The dollar wins by default.
But then the source uses an analogy that really stuck with me, the MySpace analogy.
I love that.
It's so good.
Think about MySpace or BlackBerry. In 2006, they were dominant. They had massive network effects. Everyone was on them. It felt impossible to leave because all your friends were there. They looked invincible.
Until suddenly they weren't.
Right. Network effects work incredibly well until trust erodes or a better alternative reaches critical mass. The collapse happens slowly and then all at once.
So the source isn't saying the dollar is MySpace.
No, it's much more entrenched. But the principle holds. You aren't invincible just because you are big. Rome was big too.
So we have a cracking foundation, a geopolitical catalyst, and a potential doom loop, balanced against the fact that the dollar is still the biggest game in town, but facing a crisis of trust. That leaves the listener in a tricky spot. What's the playbook here? The source actually gave some really specific advice on how to navigate this.
It did, and it moves from macro analysis to personal strategy. And the first step is redefining what diversification means.
Most people think diversification means owning Apple and Microsoft,
Well,
or maybe an S&P 500 index fund.
right. But if the dollar itself is the risk, owning 500 U.S. companies doesn't protect you, you are still 100% in the dollar system. The advice is to move away from 100% U.S. dollar concentration.
So look at international stocks, emerging markets.
Exactly. You need exposure to assets that aren't denominated in the currency that is being debased.
Okay, step 2 was hard assets.
Mm-hmm.
And the source was very explicit about gold.
Yes, and it distinguished between speculation and insurance. Buying gold, hoping it goes up next week so you can get rich, is speculation.
Right.
Buying gold because central banks are buying it to protect themselves from systemic risk. That's insurance.
It's following the smart money, essentially.
Or at least the big money.
Yeah.
If the central banks of the world are de-dollarizing their balance sheets, maybe you should have a small percentage of your portfolio doing the same. If the house is on fire, you want some assets outside the house.
What about bonds? We talked about yields rising, which means bond prices fall. That sounds like a terrible place to put money right now.
It is a dangerous place if you're in long-term bonds. The advice here is to avoid duration risk. Do not lock your money up for 30 years at a fixed rate, because if inflation spikes and rates go to 8%, that bond loses a huge amount of value.
So where do you go for safety if you need income?
The source suggests looking at floating rate notes. These are bonds where the interest rate adjusts up as market rates go up. So if rates rise, you get paid more.
Okay.
Or TIPS Treasury inflation-protected securities. These are designed specifically to handle exactly the kind of inflationary environment we're discussing.
On for stocks. Because I assume in an inflationary world, some companies get crushed by rising costs.
You want pricing power. This is key. If the dollar buys less, costs go up for everyone. You want to own companies that can raise their prices to match inflation without losing customers.
So essential goods, dominant brands, things people can't easily quit.
Exactly. If a company sells something you need, like toothpaste or insurance or energy, they can pass the cost to you. If they sell something you just want and they raise the price, you walk away. Those nice-to-have companies will suffer.
The final piece of advice was more psychological. Don't be paralyzed by complexity.
Yeah. Markets evolve slowly, then suddenly. We're in the slowly phase right now. The dollar isn't going to collapse tomorrow morning. You have time to adjust, but you have to be paying attention.
It really feels like we are at a turning point. The source mentions that the classic 60-40 portfolio, 60% stocks and 40% bonds, might be dead.
It worked for 40 years because interest rates were generally falling and globalization was rising. That was the wind at our backs. We are now in a world where rates might be rising structurally and globalization is fragmenting into these competing blocks. What worked for your parents' retirement plan almost certainly won't work for yours. The wind is in our face now.
That's a tough pill to swallow. The post-WWII financial order is shifting under our feet.
It is. And the most provocative thought from the source, for me, was this. Doing nothing is also a decision.
And usually the most expensive one.
Most people will hear this news, feel anxious, maybe complain about grocery prices, and then do absolutely nothing to change their allocation. They will stay in the default settings. They will ride the ship down.
While the people listening to this deep dive, the 5% who are actually paying attention, can make moves.
Exactly. You don't have to day trade your life savings. We aren't telling you to sell everything and live in a bunker, but just taking one action researching tips, buying an international index fund, looking into gold, puts you ahead of the crowd.
The writing is on the wall. The question is whether you read it or ignore it.
Couldn't have said it better.
Well, that is a lot to chew on. The risk-free asset has some cracks in the armor, and the great exodus has begun. We'll be back next time with another deep dive. Until then, keep your eyes open.
And stay diversified.
See ya!